Hi traders, it's Umberto, and this is a continuing education on the Pro Traders Workshop series. In this lesson, I want to talk about, address an issue that is very, very common amongst new traders, and specifically is making decisions on smaller time frames, thinking that on a smaller time frames the market is actually changing direction for a long term, and that is most likely not going to occur at least 90% of the time, and I'll show you a few examples of that. Right now we're looking at the pound yen, and if you look at the 1 hour chart, obviously the market's in a downtrend. We have bearish engulfing candle, another bearish engulfing candle. The market's been in a downtrend for the past 6 hours. However, this should be considered a retracement. It's not a reversal because it's on a 1 hour chart. I have several entries up at these levels, and all I would do is enter again as the market sells off. The trades were based on a daily chart. I'm just going to show you a few candles on a daily chart, and you're using this indicator, the super trend indicator, to help me for a directional bias. So if you look at this daily chart, the market's in an uptrend. Now, notice these candles, these daily candles. This candle went down about 240 pips and just recovered and turned around. And there's this candle here went about that 100 pips. Now, if you're trading off the 1 hour chart, you would think that this is a reversal and the market will continue to sell off. But if you look at a daily chart, all it is a retracement, and the market recovered from there and went up another 330 pips. Okay, so if you're looking at a 1 hour chart, of course you're going to think that if you just trade off the 1 hour chart, you're always going to think that these retracements are reversals. And they're not reversals because the daily and the 4 hour chart are in an uptrend, so these should just be considered retracements. Okay, I hope that's clear. I find this really disturbing for a lot of traders and let me just highlight those areas, these levels of retracements of the market just recovered each time. And the reason why is because the market on the higher time frames are in an uptrend. But it's very common to be able to take a trade thinking that the market's going to continue and not pay attention or not think that the market's going to retrace, and it's going to retrace. It never goes up or down in a straight line. So these boxes that I drew are simply retracements. The market recovers and trades in the direction of the overall trend, which is the daily and the 4 hour chart, and probably the weekly chart as well. So the weekly chart, notice these lines. The market's been in an uptrend on the weekly chart since October. Okay, this is a very common problem, and so I have several videos on how I talk about directional bias, top-down analysis, and making sure that you're looking at a daily, weekly chart to determine directional bias. Then when you trade off the 1 hour chart and the market turns against you, then there's no reason to be alarmed simply because you're down 100 pips. And that may seem like a lot, but on a daily chart, 100 pips is actually nothing. 300 or 400 pips, yes. And 100 pips, even 200 pips, it's not much. And notice that I've actually entered some more positions on this pair, and if price does come back down to a lower level, then I'll enter another position as well. Now, if price breaks below the swing point on the 4 hour chart, then yes, then I would have to get out of that trade because that's too much. My threshold of pain is not that much, and it would be more than 400 pip stop loss. I'm not interested in a 400 pip stop loss. So there you have it. Top-down analysis is essential to be able to analyze the market correctly. If you're not looking at a daily and 4 hour chart and a weekly chart, you don't know what the overall direction of the market is. Even on this 4 hour chart, notice there's a bearish engulfing candle on this 4 hour chart here, but this only lasted for 12 hours and then turned around and went in the direction of the daily chart. And the same thing is occurring now. We have a bearish engulfing candle and the market has found support and is turning around and heading north. So if the correct way to trade is simply looking at higher time frames to figure out the overall direction of the market and then scrolling down to a 1-hour chart for entries. So an entry, for example, on this pair would be here because this is a strong support level right there. And so if the market does come back down on the pound yen down to these levels at 122.48, then I would simply add another position. And you can see down here, I've got several positions open all the way down 100 pips on the pound yen. I had actually entered 10 more positions, but I closed them at about 25-30 pip profit, and I entered a few more, and I'm only down a pip on 4 positions down where you see price now at 146.86. That's it for this tutorial. If you are interested in taking your trading to the next level, you can just sign up. Just go to our website. We have several products, trade signals, private coaching sessions, and a lot of trade videos on price action. Thanks for watching the video. Talk to you guys soon.